to It's the Economy. Today we discuss how India lends, a report prepared by credit bureau company CRIF. They have aggregated a mountain of data on loans lent by all institutions, private banks, public sector banks, NBFCs, MFIs, and have come out with an interesting set of trends visible in terms of lender behaviour and borrower behaviour. The report should be useful to lenders themselves, to the regulator, more so to investors, viewers, to understand where is the loan growth and where is the pain. Joining me on the show are the author of the report, Sachin, who also is the head of CRIF, Sudipto, Managing Director and CEO of L&T Finance, Kanika Pasricha, Chief Economist, Union Bank, and Madhusudan Ekambaram, founder and CEO of KreditBee. Well, gentlemen and Kanika, thank you very much for joining us. Welcome to the show. Sachin, let me start with you. Can you begin by telling us the key things, anything surprising that you noticed in terms of trends?
Thanks, Latha. So first of all, Latha, every time we release this report annually, there are a lot of things which comes completely, surprising. So this time I'll say there are 3 or 4 points. First of all, this microfinance, the issue, or let's say the stress which has been there, I think it has lasted much longer than anybody expected. I think every quarter everybody was been tracking, and we hope that it should we should recover from that. But I think it has lasted much longer. We are seeing some signs of improvement now, I think, as that we saw the data last month. But that's one thing which was surprised all of us. Second is that if you see the share gain by public sector banks and even NBFCs in many of the segments over private sector banks, that has been a big surprise, because there has been a stronghold of private sector banks in many of the segments, including home loans, including other segments, credit cards, personal loans, etc. That has been a very, very eye-opening thing, which means that there are systemic change happening in the industry. So that's a new thing. Third thing, that the amount of focus and thrust being given by government and multiple ecosystem partners on MSME, we were hoping that there could be a lot more adoption. But I think there has been changes, or there have been improvements, but I think it's still a lot more to be done there.
Work in progress.
Work in progress, yeah. And I would say on another segment, consumer durable segments or other personal loan segments, I think we see that it's continued to be dominated by 3 or 4 players, primarily NBFC players, which is very, very different compared to other industries. So there are only 1 or 2 banks players, and NBFCs are doing far better there. So that continue to be there. So I would say, sum and substance, these are the 4 things. Everybody else, and I would
let me ask if Sudipto agrees with you. Sudipto, anything, you've been a veteran player. Anything surprised you, shocked you in the findings of the trends in FY25?
My answer will be provocative, actually, and nothing shocked me.
Okay.
So in the sense that, okay, maybe, the pace of slowdown in some places have been a little more than what I estimated for. So if you say that is something which I found probably a little more than my expectations. But the fact is that if you see, last year was a tough year, actually. From an asset quality point of view, last year was a tough year. And most of the lenders, right, they took up their sort of credit guardrails. And coupled on top of it, if you see from around from the latter part of 2023, the Reserve Bank of India also started upping its ante on sort of curbing the runaway growth in unsecured loans as well, right? A variety of actions. Now, when the regulator is also pushing you to sort of temper your growth charge, as well as when you have risk rising on the margin, which obviously the private sector banks with very large unsecured portfolios, credit cards and personal loans portfolios, so for the first time, always, and then we saw the microfinance sort of asset quality issues start bubbling in the front from the April of last year. Overall, there was a sort of a realization in the industry that, probably, the froth, as we call it, on top of the lending ecosystem had built to a certain extent that there was a slowdown needed.
That point is taken, Sudipto. What surprised me is not that the unsecured loans fell, because the Deputy Governor Swaminathan was telling us in the press conferences that 30% growth is not like, when nominal GDP is growing by 10%, you can't have a 30% growth in unsecured loans. But I was more surprised by MSME originations falling. It was a good year of growth, a decent year of growth, FY25. That surprised you?
No, didn't surprise me because Latha, have to understand that everything is connected and MSME also takes unsecured loans. Okay. So the fact is that, when you have one part of the sort of ecosystem exhibiting risk, which is in credit cards and many of the MSME, especially on their personal or the individual capacity, also borrow from the market. And the fact is that when you underwrite an MSME loan, you not only underwrite their business, you also underwrite them personally. And when you see that their personal borrowing facilities are showing signs of stress, the guardrails also go up in the MSME lending.
Fair enough.
Right? So
okay, point taken.
I think the risk perception of the industry went up, which led to increased sort of credit guardrails across all segments, which led to a sort of secular degrowth in lending in all.
Okay, got it. I'm sorry if I'm hurrying you all because it's such a rich report. I'm trying to get, some analysis on everything. The other thing that, which I want the economist to comment from Union Bank, Kanika. Kanika, it says, the report says small ticket loans saw slower uptake and higher delinquency pressures. Whereas the borrowers seem to have gravitated towards higher ticket loans. Is this saying about K-shaped recovery? What does this say?
So, Latha, first of all, thanks for having me here. It's such an esteemed panel. You're absolutely right. It is the high-ticket loans that are gaining momentum. And I'll actually connect with what Sachin talked about. The reason why private sector banks were not growing as much as public sector banks, one of the key areas is home loans. And in home loans, what we found is that private sector banks' growth is less than 5%. If I look at RBI data, I'm not quoting from How India Lends report, while public sector banks' home loan growth is around 12 to 15%. While the number of accounts growth is falling in both segments. But it's the ticket size of loans that's rising in public sector banks because private sector banks, as the cycle started to shift towards easing. They didn't want to get into EBLR-linked loans. And in fact, there's such competition in home loan market that the interest rate bucket for 9 to 11%, which had 65% share in FY23, fell to only 40% in FY25. It all shifted to 7 to 9. So private sector banks were not willing to lend there. So ticket size of the loans has shifted from private sector to public sector, and that too, we've seen it's the higher ticket size loans as part of K-shaped recovery that are growing more, while the smaller ticket size is struggling. So you're absolutely right. It's the shift in wealth effect. It's a shift in the income pyramid as well. And it's the bottom of the pyramid that's still struggling on inflation, while the upper end is relatively comfortable.
Madhu, to get you into this personal loan thing, Sachin's report says early stage stress showed improvement. Now, does this mean that we are in an improving cycle of bad loans because early stage defaults are declining?
See, I think before getting into the report itself, let me talk a little bit about what we saw in the industry as such, right? So, if you take Q1 of FY25, which was last year, somewhere in that April, May, June quarter, everyone saw the stress in the unsecured lending space. It could be either the short-term personal loan, long-term personal loan, or even the microfinance started showing certain stress. Now, it all depended on when each of the companies' stress kind of peaked. When did the risk peak, right? So, most of the NBFCs, when we see that, it peaked by Q2 and in the results, we could see that, or in Q3, somewhere the risk was peaking and after that, it was always improving. But the stress continued somewhere in the microfinance segment, and people say that it's yet to be seen. The peak risk is yet to come out and whatnot, but that is where it has continued as a higher risk within the personal loan segment. Now, specifically coming to, let's say, the fintech segments where we operate, I think what we saw was that the Q2 where the risk actually peaked, and after that it has been in a very much of a improving trends is, or the declining trends is what we have seen, and that's how the industry benchmarks are also showing. Something from the report, what I have seen is that while a lot has been talked about, there has been a risk that is in build up in the short-term personal loan or the small ticket personal loan. But if we go a little bit deeper and then look at it, less than 1 lakh rupee, the risk has not built up. The risk has built up in like 2 lakh to, let's say, the 10 lakh segment is where we have seen the risk has deteriorated over the time. But less than 1 lakh has always been performing well. That's what the data shows. But however, there has been a lot of narrative, both in the media and everywhere else there, that anything less than 50,000 or 1 lakh rupee has been more stressful. But that's not the case if we just look at the report data. And that has been a pretty good surprising element for me. Yep.
Okay, yeah, I think an earlier report had said under 50,000, but that was an old report. So maybe things have corrected since. Sachin, would you agree, from what Madhu is saying, will we in FY26 see less stress? And I'll tell you why. The financial stability report that Kanika referred to, that gave the impression, especially for NBFCs, that stress will rise. From about 2.9%, they are expecting the baseline to go to 3.3. But you're seeing some signs of early stage delinquency falling. What is your best guess of 26? Will stress be more than 25?
Yeah, I mean, first of all, it's a forward-looking statement.
Yes.
So we always look at the data from Bureau from the past. But yeah, if I say that, whatever we are seeing the signs, and we have also compared it with the last 2 or 3 years in certain situations. So if I stick to the segments what we have assessed, definitely we are seeing that certain corrective actions being taken by lenders. So microfinance, we are working very closely with the industry. We are seeing corrective actions, and we have, in fact, I can tell you what is not in the report. We have even taken the data of April also, and we are seeing that, there is an improvement.
Decline in stress.
Yeah, decline is happening. So we are hoping that when we release the report in June, or June end cut data, it will definitely have improvements. So hopefully that would be better. If we look at personal loans, etc., I think a lot of corrective actions have already been taken by every lender, and there is a very cautious approach. So that is being taken care. I think if you talk about certain other segments, I think people are shifting about asset-based lending and more of a secure lending. So there is a lot of talk happening on micro LAP, etc., which are by design a less sort of risky assets. So there's a shift in the industry happening towards that. And even overall lending portfolio, you see the growth which is happening is towards that, right? Gold loan also has been, the highest growth has been in the gold loan.
Yes.
In fact, if you see the portfolio growth, there has been a decline in almost everything except gold loan. And gold loan, RBI has already come out with saying that you need to have even a bureau check there, which most of the people are not doing, right? So with all this keeping in mind, I think the industry ecosystem, the guardrails, the RBI guidelines, the liquidity, the changes which have been done in the allocation for the MFIs, the measures are being taken. I think if you keep the portfolio as it is, I can definitely say that this portfolio will improve. But what definitely happens is that portfolio is never it's a going concern, right? So if I say that NTC customers will come in, certain customers will go through certain other changes in their lifestyle, their earnings, etc. But even the underwriting things are improving. So I would say in substance of this is, I think we will definitely have improvement in the portfolio quality. But yes, there are new lenders coming in the market. They want to gain more market share. They want to have, so there could be always a mixed bag.
Fair point.
But same portfolio, if you keep it, definitely portfolio is going to become better.